Welcome to Module 3, Section 8, where I will talk about a thing called hedge funds. Now, one thing you'll notice is the section previous to this are a little bit longer than some of the other sections. That's because I only address things like cryptocurrencies, hedge funds, and the foreign exchange market in this class. This is the only time I talk about them. We don't deal with those markets, so I felt a little bit longer explanation was due in this course because it's the only time you'll really hear me talk about them at length. So what are hedge funds? They're an alternative investment that also uses pooled funds, just like a mutual fund, to implement numerous strategies in order to earn attractive returns for the people that invest in that hedge fund. There are many different kinds of hedge funds. Some of these hedge funds can be aggressively managed. You have these managers who are out looking for the next latest and greatest investment, and sometimes that may involve taking on more risk. One hedge fund manager may be willing to assume that risk, while another hedge fund manager is more conservative, and they may not take on that risk. Hedge funds can make use of derivatives. They derive their value from something else, like a stock option. You have the stock that has its value, and then there are additional instruments called options. Well, as the stock goes up and down in value, the value of that option will go up and down. Hedge funds can also use leverage. They might use a lot of borrowed money. They may buy on margin. They may be heavily leveraged at some times. There may be times when a hedge fund is leveraged just a little bit, but other times when they see a real opportunity, they may use very high leverage. And then they also can use what are called futures contracts, which are even more leveraged than buying on margin. You can take a small amount of money and control a big asset. The value of that asset is based on the full price. And so you can have really big moves that go for you or against you within a futures contract. Hedge funds can also be active in domestic markets, such as inside the U.S., as well as international markets outside of the U.S., or a combination of the two. Hedge funds are generally only accessible to what we call accredited investors. There's some criteria that you have to meet before you can actually get involved in a hedge fund, and I'll go through that here in just a moment. Hedge funds do require less SEC regulations than mutual funds. Because there are less rules, they feel that the people that get involved in hedge funds, if they get wiped out, since they're wealthy anyway, it's not going to destroy their whole life. What are some of the goals of hedge funds? They're designed to take advantage of certain market opportunities. It may be in the stock market. It may be in the bond market, the futures market, the crypto markets, futures markets, foreign exchange, real estate, housing. All different kinds of markets are potentially available to them. For example, they can go long or short. Long meaning buy low, sell high. Short, sell high, buy low, or a combination of the two. Hedge funds use different strategies that are often classified according to an investment method. Usually you have these rock star hedge fund managers who have some secret to beating the market. And a lot of times what investors will do is they'll get involved in a hedge fund not because of the hedge fund, but because of the manager. This can be set by the hedge fund manager, and as I just alluded to, investors are usually buying a name. Charlie Smith is known as being a really good hedge fund manager, so he gets a good reputation, and that attracts more investors. There can also be substantial diversity. They have things spread out in multiple markets, and they don't put all of their eggs in one basket, so they try to spread this risk across multiple markets. And they may implement a lot of different investing methods. Long, short, leveraged, non-leveraged, heavily margined, futures contracts. All of these things can be used together inside of a hedge fund. Some hedge funds are very conservative. They don't take a lot of risks. They're looking for good quality value investments, while other hedge funds are very aggressive. They may assume more risk, but they're looking for greater returns. Legally, hedge funds are most often set up as private investment limited partnerships, and they're open to a limited number of investors and require a large initial minimum investment. The one nice thing about a limited partnership is you, the investor, are limited in your liability. If the hedge fund does something wrong, you might lose money, but you're not going to go to jail because of something that happened inside of the hedge fund. People that manage the hedge fund may have some legal problems, but you as an investor don't. Investments in hedge funds are illiquid. You can't really get in and get out of these things very often because they require investors to keep their money in the fund for a specific period of time. If you get involved in a hedge fund, it might be tied up for 2, 3, 4, 5, 10 years. If you need to get to that money, you're going to have difficulties getting to it. Where with a lot of mutual funds, if you need the money tomorrow, you can do everything today and that money should be in your account almost instantly. Think of it like some of the investments at a bank. You buy into a CD, and if you hold it for the duration of that CD, then you get the full amount. They're trying to discourage people from pulling money out once they put it into investments. And hedge funds use a lot of the same principles. This can help to hide what's going on in a hedge fund because these managers have their super secret ways of doing things. They don't want everybody to know what they're doing. Now, that can really be to your advantage if what they're doing really gives you good returns, but that also means that there may be a lengthy period of time when they're doing wrong things and you don't find out about it well into the future. Withdrawals may also happen at certain intervals. They may say, okay, you can take some money out of the hedge fund, but you can only do it every quarter, or maybe twice a year, or once a year, or after you have held on to this hedge fund for 3 years. They really try to put the limits on that. And if you think about it from their view, that makes sense. People putting money into this, they're tying up that money into investments. If a lot of people are trying to get their money out of a hedge fund at the same time, that can create a lot of problems because they have to change those assets into cash and then give that cash to the investors. That can really ruin the returns and make managers do things that otherwise they would not do. I'll go through just a brief history of hedge funds. The first hedge fund was launched by A.W. Jones and Company in 1949. So these things have been around a good length of time. The long and short equities model was implemented along with leverage to enhance returns. So on the scale of conservative to risky, this hedge fund was pretty conservative. They could go long and short, and they could use leverage by implementing margin in order to enhance returns. This goes above and beyond what most mutual funds can do. Then in 1952, the structure was changed from a general partnership where anybody who owned it was liable into a limited partnership. Only certain people have legal liabilities where everybody might have a financial liability. Also, a 20% fee based on performance was added as compensation for the managing partner. Again, this is a merit-based investment. If the investment does good, the manager should be rewarded. If the investment does bad, the manager should not get a reward for that. And 20%, that is a lot higher than mutual funds. And I'll go through a little bit more of that here in just a moment. Other hedge funds were created. This became kind of the craze throughout the 50s and 60s. Hedge funds did outperform most mutual funds in the 1960s. They have more freedom. They can do more things. And when you're in a market-friendly environment, you see enhanced return. As hedge funds evolved, they developed riskier strategies that were implemented by the managers. They have to attract customers. How do they attract customers? By their returns. How do they get higher returns? By taking more risk. Some led to heavy losses, followed by a large number of hedge funds going defunct in the 1970s. And that still continues now. There are a lot of hedge funds that go out of business. There are new ones that are being created all the time. Renewed interest came then in the 1980s when investors entered thousands of different hedge funds that offered very exotic strategies, including currency trading because of the deregulation of the currency markets, and different derivatives such as options as well as futures. These markets became a lot more liquid. You could get in and you could get out quickly. You could see really good returns on some of these investments as well as hefty losses, and hedge fund managers really decided to take advantage of them, and they continue to do that today. In the early 90s, well-known money managers left traditional mutual funds to become rich and famous hedge fund managers. Some of these guys are really treated like rock stars. If they're a good money manager, they get the best seats at sporting events. They get to eat in the nicest restaurants. They have private jets. They live in big mansions. And if they're really good at what they do, they are very, very well compensated for that. When we see a big downturn in the overall market, we usually see a pretty big downturn in hedge funds. This can escalate any problems. And in fact, some of the reason behind the 2008 collapse can be caused by hedge funds, where hedge funds were going down and then that took the rest of the market with it. Where in 2000, with the dot-com bust, that was more of the market going down and then hedge funds losing because of that. So the cause and effect were kind of switched in that scenario. It's not that simple to make that plain vanilla of an analysis, but that's kind of what happened. Nevertheless, after these problems, the hedge fund industry continued to grow. People want returns. They don't want to take the time to do it themselves, so they're willing to put a large chunk of money in the hands of another manager who will manage it on their behalf. And all they really care about, what does their statement say at the end of every month or every year? What kind of a return did they get? Today, hedge funds manage more than $3.2 trillion. These are some pretty big players. We follow what hedge funds do, not because we get in and out of hedge funds, but because they have trillions of dollars that they're putting into and taking out of the market, and they leave a giant footprint. We can see when these things are happening. Hedge funds may be big money, but they're not necessarily the smart money. Sometimes we can get a little fooled by that because it might look like an institution or a central bank or some of these investment conglomerates that really do know what they're doing. It might look like that's what's happening when really it's a hedge fund that's doing it. As of 2002, there were about 2,000 hedge funds and about 10,000 as of 2015. So you can see there's a real solid growth there. But since 2016, the number of hedge funds has been declining. We've seen a real strong bull market from 2016 up until near the last quarter of 2021. Who needs a hedge fund manager? You can be a genius all by yourself and see really good solid returns without paying that extra money that you normally would to a hedge fund manager. When this type of an environment occurs, you see a decline of hedge funds. Plus, some of them just go out of business. They make bad decisions, they leverage themselves too much, they use crooked methods, and then they're caught, and the hedge fund ends up collapsing. What are some of the characteristics of hedge funds? The SEC, Securities and Exchange Commission, which I have another section in this module that talks about that, they state that hedge funds are only open to qualified or accredited investors. And here's what that means. You have to have an annual income of over $200,000 for the 2 past years. Now, we just got done with the whole lockdown thing, and we're still in it to a large degree. People that may have had a really high income in 2019 may have seen that income really fall in 2020. So they may not fit this qualification. But there's another qualification. You have to have a net worth of over $1 million, and that doesn't include your house where you live. The SEC has deemed that these investors are suitable to handle potential risks. Basically, if the hedge fund goes out of business and they get wiped out and all their money is gone, they'll still be okay. But at the same time, I've seen some very wealthy people make some very non-intelligent decisions when it comes to the financial markets. The inverse is also true. There are lots of people who are not necessarily wealthy, and they make very good decisions when it comes to the financial markets. The premise here is that if that money goes away, it's not going to wipe out somebody completely. The things that a hedge fund can invest in is only limited by its mandate. They may have some kind of a mission statement, also called a mandate, that says, we're looking for high growth potential investments, and we may implement leveraging and futures contracts in order to do it. Now, that's pretty broad and very vague, and that really gives the manager a lot of leeway to do whatever they want to do. But they try to define their overall general method so that investors have somewhat of an idea of what they're getting into. A hedge fund can basically invest in anything: land, real estate, and there is a difference, stocks, derivatives, currencies, cryptos, overseas markets, U.S. markets, pretty much anything. Mutual funds, by contrast, they have to follow a prospectus. In the previous section on mutual funds, I go more in depth about the prospectus, which are pretty much the laws of that mutual fund. And a mutual fund manager can't go outside of what the prospectus says they will do. Usually, this only involves long positions, buy low, sell high. There are exceptions, but most mutual funds do not go short. They may not implement leveraging. They may not implement futures contracts as a general rule, but there are some mutual funds that do. They have to tell you that in the prospectus. Well, in the mandate that you get for the hedge fund, they may be a lot more general, and so you don't really understand as much about what's really happening. Hedge funds often use leverage, which is borrowed money, to get better returns, and I've covered that a few times. And then there's the fee structure. Instead of paying an expense ratio only, which is what a mutual fund does, hedge funds can charge both an expense ratio and a performance fee. And typically, this is 2% of the assets that they manage. That's an asset management fee. And then 20% of any of the gains. Hedge funds can pretty much do anything as long as it's disclosed to investors, but you may not really find out about this until after it's happened. This can be very risky. Some huge failures have involved hedge funds, but other hedge funds have produced some fantastic returns. There are good hedge funds out there. There are bad hedge funds out there. So why is it even called a hedge fund? Hedging is the practice of attempting to reduce risk. If you have a long position, you may buy a short position to hedge that, so that if the value of your investment goes down, the value of your hedge or your insurance goes up to replace whatever you've lost. That's the idea of hedging. However, most hedge funds, they try to maximize returns. The name hedge fund is mostly traditional and does not accurately describe what most hedge funds do. So don't confuse hedging, protecting yourself, with hedge funds, the same name used in completely different contexts. Hedge funds use dozens of different strategies and may not even implement hedging, but they're still called a hedge fund. Some hedge funds are very risky and speculative. Some people like this. They get excitement from that. This is money they can afford to lose. So they don't mind putting this out there just for the thrill of possibly getting some astronomical return. What are some of the risks of hedge funds? Certain investment strategies expose hedge funds to potentially huge losses. If you have a lot of futures contracts out there that are heavily leveraged and prices go against you, that can lead up to some really big losses quickly. And because these hedge funds are big, they can't get in and get out like we as individual investors can do. We're like a little speedboat where we can zip in and zip out of the market when we want. Well, a hedge fund or anything large like that, they have to unwind their positions over a period of time. Just like when they're getting in, they don't buy all at once. They buy incrementally until they have all of that investment that they want. And this can take some time. If the market is moving really fast, that could really move against them and lead to some large losses. Hedge funds typically require investors to invest money for a period of years. And I stated that earlier, that they're not really liquid. You can't get to your money once it's tied up. The use of leveraged or borrowed money can also lead to significant losses. Methods that may have worked during certain periods may no longer work. Because these guys are huge, because we can see what they're doing, other people notice that, and then they start doing the same thing. And when a lot of people use the same strategies at the same time, that strategy that was very successful tends to break down. Plus, market conditions can change. We might be going up overall, but the reasons for going up might be different from when we went up 10 years ago. Some hedge funds have participated in illegal activities such as insider trading. Just to give you an example of insider trading, let's say that I am the CEO of a pharmaceutical company and I go out and I want to play some golf one day and I meet you. We've never met before, or maybe we are already friends, but we're out playing golf together. I tell you, yeah, I'm CEO of a pharmaceutical company, and you tell me, oh, I'm a hedge fund manager. And I say, we have this drug that really helps with COVID-19. And we got the test results back, and they were very favorable. This hasn't been announced yet, but you might want to consider buying some of our stock. Now, what I just did is illegal. I told you private information that's not available to the public. You, as the hedge fund manager, you also did something illegal where you took the information that I told you and then you acted upon that to give you an unfair advantage to the general public. Now I'll talk a little bit about the hedge fund manager pay structure. They typically require a fee of 2% of the assets. So they're going to get that no matter how things perform, and 20% of the profits every year. So even if the hedge fund manager loses money, that manager will still receive 2% of the assets. Some people don't have a problem with that. They're like, hey, it takes money to make money. This is a really good manager and they've served me well over a period of time. We had a down year this year. I don't mind if they still take 2% of my assets. Other people think that's really unfair. For example, a manager overseeing $1 billion and they just do nothing that year. They don't invest in anything. They keep it all in cash. They would earn $20 million in compensation without even doing anything. There have been fee limitations known as high watermarks to prevent hedge fund managers from getting paid on the same returns twice. Yes, this would happen. They would set up these investments and their whole accounting in such a way so that the manager would get compensated more than once. And some hedge funds even implement fee caps to prevent managers from taking on excessive risk. I don't go into a lot of detail in that, but they've tried to make it a little more investor friendly. Because when you're involved with money and you're managing money on other people's behalf, and you may have done something before that was successful, that doesn't necessarily mean it's going to be successful again. And so you have a lot of these managers who are trying these different strategies and they're not working, so they might double down and invest even more, thinking this has got to come through, this has got to come through. These people are human beings. They have the same emotions that we have. They may have access to a lot more information than we have, but they're still human beings nonetheless, and they're prone to making mistakes and doing things out of fear and greed. What about the taxes on hedge fund profits? Domestic U.S. hedge funds are subjected to capital gains taxes. So if you have a hedge fund that's set up in the U.S., you fall under U.S. tax laws. Short-term capital gains, those things that are held for less than 1 year, currently are taxed at different rates than gains that are held for longer than 1 year. This might change. This is changing all the time. And we have a new administration who's making a lot of changes, who wants to really, really raise taxes. And this may still be here, or it may end up going away. So we'll need to double check on that, not only for hedge funds, but for us personally. And where do we stand on that? And how is that going to affect us? The tax rate then is at the personal tax rate. It flows through to whatever that person's tax rate is. The tax rate for long-term capital gains are usually 15 to 20%. Taxes apply to both U.S. and foreign investors. So if you're listening to this and you live outside of the U.S., but you still invest in hedge funds, you're still going to be subject to taxes because things are taking place in the U.S. in this particular hedge fund. So what a lot of hedge funds have done is they set up offshore that are established outside of the U.S. They're usually located in countries with low taxes or are even tax-free. Switzerland is very popular for a lot of hedge funds. And there are other types of hedge funds called reinsurance companies that are often set up in Bermuda, and they do this to avoid taxes. Whether that's right or wrong is not for us to say. This does happen, and many hedge fund managers will take advantage of this. So what ends up happening is investors don't have any U.S. tax liabilities on the distributed profits because these hedge funds are set up offshore. And that's real enticing to some investors. What can we see for the future of hedge funds? Hedge funds have had a lot of controversies surrounding them, which have included insider trading, and I gave an example earlier. Tax avoidance, they may set things up in such a way so they're trying to avoid taxes, but they do it in an illegal way. Management overpayment, a lack of regulation. There used to be no regulations on hedge funds. Now there's a few more. Why do you think that is? That's because a lot of the politicians make use of hedge funds, and they don't want all the rules that they set up that are applied to you and I to also apply to them. But if something goes wrong, you can bet that the regulations are going to fly. This has led the SEC and the Congress to consider new regulations for hedge funds. And this has been the debate for decades now. But hedge funds have a lot of clout. They have friends on both sides of the aisle. They not only support Republicans, they will support Democrats, whoever's in power. They have heavy lobbying abilities. And so some of these rules that you would think would get implemented, they don't feel are in their best interest, and so they don't get implemented. But still, things that you'll hear, especially when a hedge fund goes under and you hear about all these people that lost their money and they're crying and they thought everything was fine. That's usually when you hear talk about, we need more regulations on hedge funds. They have too much freedom and they took my Aunt Martha's money and it's gone now. We need to do something about that. Also, hedge fund advertising rules. Some changes have been very slow because many hedge funds have lots of money, power, and influence. That's why these changes don't take place, because they have the ear of people that do implement the changes. Let's compare hedge funds with mutual funds. Now, most of you that watch this, you're going to be involved in mutual funds or exchange-traded funds. You're not going to be involved in hedge funds. What are some of the similarities? They both have money managers, and they manage portfolios. Somebody on your behalf goes out and finds investments for you. They also offer diversification. They spread out the pooled money across many different investments. Some of the differences are hedge funds are managed much more aggressively as a rule than mutual funds. There are risky mutual funds out there. I'm just talking in more of a general sense here. Hedge funds can take on speculative positions and securities such as options, currencies, and futures. And I've talked about that before, where most mutual funds won't do anything like that. Hedge funds can short sell stocks, where most mutual funds, they can't do that. If it doesn't say that in their prospectus, they can't do that. If it's alluded to in the mandate from the hedge fund, then they can do that if they want to. Hedge funds can use leverage, again, where most, not all, but most mutual funds don't use leverage. Mutual funds are considered to usually be safer. There are exceptions. There are safe hedge funds. There are risky mutual funds. I'm just talking in a very general, generic sense. The availability. Hedge funds are only available to those sophisticated investors, which is kind of interesting because a lot of people that have a lot of money are not necessarily sophisticated investors. They may have made their money doing something else in the arts, music, painting, writing a book. And they're really good in that area, and they get a lot of money for that. And for some reason, they're labeled as a sophisticated investor with a high net worth, when really they don't know anything about the market. The government deems these investors as accredited. The criteria for becoming accredited can be lengthy and restrictive. And I talked about that at the beginning. Mutual funds are very easy to get into. You can go down to your bank. A lot of you that have a 401k or a Roth IRA, you're probably using mutual funds, and it was probably not all that difficult to set this up. You can go on the internet and set up an account with a mutual fund company relatively quickly and be investing in a short period of time, where a hedge fund, they won't even talk to you. What are some thoughts that I have on hedge funds? For most of those that are involved in the program that I teach, the SPX investing program, we only need to know about hedge funds. That's why this section is a little longer. I will refer to them in my classes and in my daily and weekly update videos. So it's good to have a basis of knowledge about hedge funds. Hedge funds can be very large with billions of dollars under management, billions and billions, just like Carl Sagan. And I talked about this a little bit earlier. Hedge fund action can often appear as smart money. That's what we want to do. We want to figure out what is the smart money doing, and then we jump on and do the same thing. Well, if big money comes in and does something, it may look like smart money. That can be really challenging for us to be able to tell the difference. And I do my best to try to spot these things, but we're not always right because of the secretive manner of what's going on. Hedge funds may be big money, but they're not necessarily considered smart money. The goal and the challenge of the SPX investing program is to differentiate the big money from the smart money. And I have a lot of tools that I use to do this. And I study these things every day. Our goal is to follow the smart money as much as possible and then do the same thing that they're doing because they have the most influence on market conditions. There's the old adage, How do you know that an elephant has walked through your living room? You can tell by the tracks. Well, when the smart money or the big money does something, we can see when that happens. We may not understand it. We may not know, is that really smart money or just big money, but we can see what they're doing. So that concludes Module 3, Section 8, and I will pick things up again in Section 9.